if money is everywhere, if it's easily created, if it easily can be circulated, if it grows on trees, let's figure out how we can blend it all with the people that we know, care about, love, and trust.
Thank you, everybody. Good morning. My name is Hector Hernandez, and today we're going to talk about 3 ways to finally stop trading your time for money. Luis, if we can get right on it. As I mentioned, my name is Hector Hernandez, and I love helping extraordinary people live life on their terms. I am currently a real estate fund manager. I am a father of 2 amazing little kids who I love the most, and they are my why. They are first-generation Americans. I am an immigrant myself, and my goal is to just leave my legacy behind for my kids and for my family. I am extremely passionate about helping others create passive income and generational wealth with what has created my wealth, real estate. I don't want to take up too much time talking about me, so Lou, go ahead. What you got?
What do I have? All right, guys. My name is Luis Alejandro Lopez. I'm been a real estate investor for about 13, almost 14 years. Proud husband. My anniversary is actually 20 years. We're going to be anniversary in December. He deserves a medal. Like Hector, I moved to America as well, but I moved to America as a grown-up. I moved here at 29 years old with $4,000 and figuring out the American dream. So I'm well on my way, thank God. Also, my kid is first-generation American, and we're working just to leave him a legacy. You know, I'm trying to change my family tree. My family had a lot of issues with money, and that's the reason why we're doing. I flipped profitably more than 180 properties throughout my career. You're going to see, we're going to talk about them. I love single families. I love condos. I love townhomes. And, you know, within the career, I've been done a lot of them. Real estate is changing my life. It's changing my family tree, like I said. And I love turning around properties. I love dilapidated properties. I love to turn them into a crown jewel. That's why I do it. So now, disclaimer, we are 3 guys on the internet talking to you about money, right? We are doing this presentation as an entertainment and education. We're going to show you how we've done it, okay? And show you the path so you can walk through it. However, every decision that you take, every decision that you make, every decision where you put your money, it's yours and yours only. If you want to consult, if you want to talk, if you want to discuss, we're here, we're open. But at the end, the decision is yours. Okay, so let's start over. So why? Why would I stop trading my time with money? What if I love my job? What if I'm a doctor? What if I love what I do? Hector, why would I keep doing it? You know, why would I stop going every morning at 8 and 9 morning to 5 over and over and over again? Talk to me, bro.
Freedom, baby. Freedom. It's absolutely my favorite part about real estate. And yes, you can make a ton of money. And I have a lot of friends that make a lot of money in their day job. They're doctors, lawyers, business owners, and they do really well. And they absolutely love what they do. But they still invest in real estate because there will come a time when they're going to want to do something else with their time, whether it's travel with family, start a nonprofit, whatever the time may be. For me, it's always been freedom, and it's always been that legacy, the ability to do the generational wealth for my family and to leave that behind when I'm no longer here.
All right, so we're going to show you 3 different ways to stop trading time for money. The first one we're going to show you is buying rental real estate. We all know what rental real estate is. There's no more land being built. Everybody needs a shelter. What's up?
Oh, my bad. Keep going.
No worries. Everybody needs a shelter. I hear you, brother. Everybody needs a shelter. Everybody needs a place to live. And, you know, real estate has been historically one of the assets that keep growing up on time. Yeah, there are dips, but overall keeps growing up on time in value. So let's go talk about what are the benefits of buying rental real estate. First, you have cash flow. If you do it correctly, and if you do it the way that we show you guys, we are going to have positive cash flow. That's usually money coming into your pocket every month, okay? You will have leverage. You will not do it all with your money. You will use part of your money, and if you do it the right way, the way we show you and the way we explain to you in the real estate show and every other time, we're trying for you to use the least amount of your money and leverage that amount of money with hard money lenders, with loans, with partners, whatever you want it, so your money can go a long way. It's way better than to, use all your money to buy one home. Instead, you use your money to put down payments in 5 different homes. Okay, you're gonna have way more leverage. You're gonna have more cash flow. Your money is gonna be diversified. Okay, what happens if you put all your money in one home and something happens to it? You have an issue. Okay, you have no cash flow coming in. Diversify your money. Use your money wisely. Put a little bit here, a little bit there, a little bit there, a little bit there. If you stop receiving rents for one reason or the other, or one of your assets, the other one still will give you the positive cash flow. Shelter, like I just said, everybody needs shelter, even if the economy is good. When the economy is bad, everybody needs a shelter. Everybody needs a roof overnight. Okay, you will create wealth. How will you create wealth? Like I said, the property values historically have always gone up. Okay, so over time, you will get additional wealth. More so you buy today at, let's say, 200,000. In 15 and 20 years, that asset is going to be 500,000. It's already paid off, and it's paid off by your tenant. And there's tax benefits. I'm not an accountant. Hector's not an accountant. Jeremy's not an accountant. But if you talk to your accountant, you will see there's lots of tax benefits when you have real estate property. You can deduct a lot of your expenses and you still have your income. So at the end, your taxable income can get reduced if you own real estate. Okay.
And that's one of the things that Hector mentioned earlier, team, about business owners and doctors or engineers, anyone who loves their job. You love trading, doesn't matter. You can love everything that you love, but like, why pay more taxes if you don't have to? So this could be a reason that if you do love your job, if you do have an amazing career, but your income is a little on the higher side, and you want to reduce that liability, that tax liability, real estate's a phenomenal way to do that.
Absolutely. Because at the end of the day, we all know it's not what you make, it's what you keep, right? We all got to share with Uncle Sam, but let's share the least amount possible.
That's right. Yep.
The least amount possible legally.
Yeah.
And real estate lets you do it.
Exactly. So now I just want to kind of reiterate a couple of things on this particular one. When it comes to residential rental real estate, it's not really about the type of property. It's, that more so comes of where you're at, what stage of your investing career and your wealth building strategy you are at. It could be as small as a condo, a mobile home. It could be as big as a 10-unit apartment building or a bunch of houses or duplexes. It doesn't really matter. The main rule here, if we're going to stick with today's strategy, is that it must cash flow. Cash flow is the name of the game, because remember, we're trying to stop trading our time for money eventually, right? So we need that cash flow. And most importantly, probably second most importantly, is you must hire a property manager. Otherwise, you're just buying another job. I own a property management company. I know the headaches that come along with it. I've been in property management, and trust me, it's not something you want to take on if your goal is to stop trading your time for money. So please make sure that if you're going to utilize this strategy right here, you cash flow nicely even after your property management expense. Don't take on another job to save that 5-10%, whatever property management cost in your neck of the woods. Throughout the country is probably between 5 and 10%. It's not worth the headache that you're going to get yourself into if you take on this whole challenge all by yourself. All right, Luke, what else you got on this?
Totally agree. Remember, the whole goal is to wait for the checks to come in the mail, to go chase them.
Oh, I love that, man. It might date us a little bit, but mailbox money, right? That's what it used to be called. I know now it's I don't even know, Cash App money. Cash App money, Bitcoin, whatever we want to go. I know we got digital these days, but it's the same concept. You make money while you sleep, while you travel with your family, while you're at your kids' sporting events. That's the goal here. It's not to be taking the phone call from your tenant because the toilet's leaking.
Mm-hmm. And that's one of the risks that we have with rental real estate. Okay, again, it's an investment, so nothing is secure. So we have a couple of issues there. For example, liquidity. If you need your money immediately, the money's tied up to the property. You will need to sell it, you will need to refi, and things take 30, 60 days for you to cash out on the money if in case of an emergency. If the economy is the problems with the economy shrinks, you lose a tenant, people start losing their jobs, etc. Okay, you're gonna go through dips. Everything goes through dips, even though we're still going up. We are gonna go through dips, and you will have maintenance costs. However, those maintenance costs, if you run your numbers correctly, like we show you, the maintenance costs are gonna be part of the income that you have, and you should have that money separate already in an account ready for take care of whatever it is, if it's the AC, if it's the heater or whatever problem that you're having, the money's there and ready to be take care of the problem. You have another set of risks, which are the risk on the right side. You have risk of vacancy. What happens if the property stays empty for 2, 3, 4 months? Who's making the mortgage payments? You are. You will have issues with difficult tenants. They are there, okay? And you need to be very, very familiar with your landlord laws. However, if you take a look at all the risks that are on the right side of the screen, you'll see that those risks, again, are being handled by a good property manager. So again, like we always say, get a good property manager to take care of your vacancies, to take care of difficult tenants. They will do background checks. They will run credit scores. They will run, they will check that the tenants are fine, and they will proceed in case you have a problem. They will proceed solving the problem with the loss of your market. Okay, remember, the United States is huge, so the laws change a little bit here and there. Okay, Hector, what would be the second way to do it?
Actually, before we get off this one, man, I did kind of want to reiterate some of what you said in the benefits tab, because I was just kind of remembering a really cool story. And I love the benefits of residential real estate. As you know, I'm very passionate about it. I've been in it for a long time. I've owned quite a bit of it. And it's the wealth that you build by the asset continuing to grow. But more importantly, it's that mortgage pay down, right? Because even if the equity fluctuates throughout time, your tenant is paying that mortgage down for you. So regardless of what happens, you will, at the end of it, if you decide to own the property the full length of the 30-year mortgage, 15-year mortgage, whatever you decide to do, you will have a free and clear asset to cash flow. And as Luis mentioned, also the shelter aspect of it, right? Life takes many turns. And one of the cool things about residential real estate is that if you are growing, if you're moving and you have a particular property, you can move into it. If you're downsizing, you can also move into it. Or if you're just starting out, you can do what's called house hacking, which I'm sure everyone here is familiar with. We've all done it. We've all been there. I purchased a home myself for my mom many years ago, probably 2010, 2011. And that's exactly what I did. I knew I wanted to buy the house for my mom. I wanted her to be comfortable. I wanted someone else to pay that mortgage off, though. I don't want to be the guy to pay that mortgage. So I split it up. I made it a duplex. My mom lives very comfortable in her side. Our tenants are great. They live very comfortable on their side. And someone is now taking care of that mortgage, paying off an asset that my mom will have for the rest of her life, which will then revert to her grandkids, my kids. And all that courtesy of my amazing tenants that have been with me for several years. And then before that, it was some other tenants, and they're going to continue to be with me. And they are the ones building that wealth for us and giving us that flexibility. Furthermore, I needed to move into that property when I first moved back to South Florida. I don't even remember how many years ago now. It was vacant. The tenant, the rental side of it was vacant. I happened to be able to live there. And now, of course, I was paying the mortgage at that time, but I lived there for as long as I needed it until I bought my next home and moved on. So that flexibility of these residential properties is amazing, guys. Not to mention, you could also Airbnb if you really wanted to. Not that I'm voting for that on this particular. That's a Lewis venture.
Yeah, but that's
Gina. It's about the freedom. All right, Lou, let's get to our second way. Let's get a 2 on the chat, guys. If there's any questions, please go ahead and put them in the chat. If not, give me a 2 if you're ready to move on to our second way that you can finally stop trading time for money. All right, Jay is ready. Renee, Carrie, everybody's ready. Okay, Chris. I love it. So the next way that we can stop trading our time for money is to invest in residential real estate funds and syndications. Essentially what this is when a group of investors pull their money together, and it's typically done in an LLC, as you can see here on the top left-hand side of your screen. We tried to give you a little bit of a layout so it's easy to understand what a fund or a syndication is for those of us who are not familiar with it. There's essentially two main groups of investors that participate. Your active investors, who are on your left side of your screen here, and your passive investors, who are on the right side of the screen here. The active investors are called the sponsors or the syndicators, and they're basically responsible for, from A through Z, everything. They got to find the property, they got to develop the business plan, they have to run the operations, they contribute a little bit of capital. It's always good to partner with guys that contribute a little bit of capital. And in exchange for that sweat equity, they get some equity in the project, they receive some fees, and they participate in the profit share. On the right side of the screen comes the passive investors, the guys that have some additional capital laying around and they don't want to buy the rentals. And they, even with a property manager, yes, it doesn't take as much time because you're just managing the asset and you're managing your property manager. But say you want it to be absolutely and completely hands-off, this is the strategy right here. The job of the passive investor in a syndication or in a fund is simply to contribute capital. And then they receive equity for that capital that they contribute. And more importantly, brings us back to the very, very important fact that they get cash flow and dividend. They participate in all the profit share that business venture, that property that they bought, whether it's a multifamily, whether it's a mobile home park or a triple net property, an apartment complex, several single family houses. You get the point, guys. There is a gazillion different types of real estate assets, and as long as they cash flow, these are really good passive investments for syndicators to create for their investors. There is some syndications and some funds, however, that invest mostly in debt and in new construction. So those are a little bit different. Today, I'm focused here in the ones that invest in cash flow and assets, because that's what our goal here today is, to receive cash flow in order to finally stop trading our time for money. Does everyone understand the structure here more or less on the screen, or is there any additional feedback that I need to provide on this slide right here? Does it make sense?
The big feedback is that you know where that cash flow is coming? In the mail.
Yeah.
More money, bro.
ACH, bro. But yeah. It's all digital, bro. All right, that's perfect. It seems very clear here. Whoa, I love it. Kevin asked a very good question. What kind of cash flows and returns do you see with syndications? Well, that varies, obviously, but on the market, what I've seen over the last probably 12 to 24 months, most syndications are somewhere in the teens. They get to produce a little bit more cash flow than your typical, because they could be a little bit bigger. And that's actually one of the benefits here that it brings me to our next slide. Because a lot of the times these funds or the syndications are investing in either large portfolios of properties or large pieces of real estate, they tend to produce a little bit better profits. So those returns are then shared with the investors at a higher return. Like I said, most of the time I've been seeing between 10 and 21%, as high as 21%. Obviously, you want to be a little wary of anybody promising exuberantly high returns, but yes, they are out there for sure. I've seen plenty of them returning in the 20s and even the 30s. But obviously, those are what we all want, the unicorns. The benefits here again is passive cash flow, and this one, like I said, is truly passive. You're basically, the only task that you have here is to evaluate the sponsor and to evaluate where they're investing at and make sure that you're comfortable with that strategy. It has to match where you're at, what stage in your investment career you're at, obviously, and make sure that you're getting the benefits that you want out of it. It is a very, very good way to diversify your assets. When you're talking about funds, there's typically portfolios in those funds. There's multiple properties. So by nature, that fund is already diversified. You're talking about property-specific syndications. Then you can also diversify by areas of the country. You can invest in multiple syndications. So that way you're not with the same sponsor or in the same market. You could be in Texas on one, Tennessee in the other, Florida in the other. And that's going to really allow you to be diversified, not just in asset type, but geographically, because you can invest in a syndication that does self-storage and in a syndication that does fix and flip, and then another one that does Airbnb. And now you have various asset classes. Jeremy, what's up?
Yep. And I was going to tell that too. So when you're talking about the syndications team, Hector is absolutely 1,000% correct as always. But one other thing to note is when you are dealing with syndications, you have bought a ticket into the room. Think about that for a moment. You are now part of a team of people that you can message and get information. You can talk to, like when they have conferences, when they have masterminds, when they have dinners, when they have seminars, you can most likely get a ticket literally to the room because you are now an investor in one of their projects. And when you surround yourself with powerful, amazing, incredible, rich, wealthy individuals, you become powerful, incredible, rich, and wealthy. That's what happens. Proximity is power. And this has been something that I've spent all of the last 15 years of my life really, really studying massively, is how I can, even if it's an IRA, 401k, if I can do a self-directed, if I can put $50,000, $25,000, $75,000, $10,000 into certain projects, spread my diversity around, but now I have connections. Now I have friends. Now I have people. Now I have a network that grows, and they know that I'm a serious investor. They know who I am. And if they know who I am, then I can have the seat at the table. And you want to spend money to get the seat at tables. It's absolutely a fact.
This is true. What is it? Your network is your net worth.
That's it.
I've heard that a time or two.
That's it, baby.
Yes, sir. You couldn't have said it better, Jeremy, for sure. It is about being a part of a group. And for the most part, like Jeremy said, these are very advanced management teams with a lot of experience. And so they're going to be surrounded and continuously doing things to grow mentally and, of course, to create wealth and to grow their wealth. And you're in one project, you get invited to the next project, you get invited to the mastermind, so on and so forth. You get the point there. And the tax benefits that come along with these. There's a little asterisk there because some of these that invest in other things other than real estate, the tax benefits get a little bit tricky. So some of these syndications and funds like Fundraise, they basically make out loans. Those don't have the same types of tax benefits than the syndications that buy real estate itself. The tax benefit comes from the real estate itself. Okay, we got a couple questions here in the chat. Team, please fire away your questions as we go through these. Sochi asks, do you own a syndication? Absolutely. I participate in syndications. We are syndicators, and we do sometimes partner with select investors to participate in our investments. How do you get into a legit syndication? That's where the that's where the fun begins. Lou, if you could share your our link with the group here. If anybody's interested in work with Lewis and I, you can obviously set up a meeting with me, calendly.com/Hector24. And Lewis is going to share a link as well in order to get a hold of us. But essentially, Sochi, to answer yours and Blake's question, right? Because Blake asked, what is the best source to find the best syndications? And that's going to be going to these types of events, going to real estate events and going to masterminds and finding out who are the pros. Right, Jeremy?
Yeah. The answer, Sochi and Blake, is this. This is how you do it. You sit down and you listen to people and you go, I like this guy. You know how many people I haven't liked? You know how many deals that come across my desk? I'm like, this is sketchy AF. Like, I'm not going to buy apartment complex and whatever Wisconsin I've never heard of. I don't know who this person is. I don't know anything about the deal. Like they didn't present information. I want to work with people that I know, that I've met in person, I've seen, that I've shaked their hand. Like that's how I want to do business, how I want to operate. But one other factor to keep in mind, when you find individuals, peoples, or companies that you do want to do business with, keep this in mind, my friends. You can get certain perks just by referring people to those syndications. So let's say, Blake, you have 25 amazing friends that you know really well, and 3 of them have some extra money burning a hole in their pocket. And you send 3 of those people to a syndicator, like myself, like Luis, like Hector. You send those 3 people to a syndicator, they get into a deal, and they all put in $200,000 into a deal. And they're happy, they're making money, they're making cash flow, they're making residuals, they're getting the tax benefits, they're doing all the things. But then that syndicator could go, hey, Blake, thanks for sending me $600,000, which is 3 times 200,000, right? I'm going to do this for you. And I don't know what this is. It can be up to them, but I've had everything from flights to hotel rooms to a check in the mail to a really cool gift to good books to all kinds of things, just because people are like, hey, man, thanks for helping me fund my deal. And I mean, why not, right? Because if money is everywhere, if it's easily created, if it easily can be circulated, if it grows on trees, let's figure out how we can blend it all with the people that we know, care about, love, and trust.
Exactly. Perfectly well said. And yeah, those benefits and just the fact of sharing love, right, Jeremy? It's not it's done without expectations. I'm sure when you've done it and you're just happy to receive a nice hug in return or whatever the case may be.
Yep, absolutely.
JD asked, what is the protection on the or the risk protection on the fund if a project or real estate runs into issues or the market downturns? JD, just like all investments, there's risk, obviously, and market is one of those risks. Lou, if you want to flip to our next slide so we could go ahead and dive into the risk. We're wallowing in all the benefits, but yes, team, there is risk. Everything has risk. There's risk in taking a shower and walking and driving, and more importantly, in investing. It happens every day. So what's your main safety, if you would, in these cases is the professional, the team behind it. That's why, like Jeremy said, you want to invest with people that you've heard, that you've known, that you've met, that you know master their craft, that they are not doing this for the first time, that they're not going to go out and take unnecessary risk with your money. It's not so much about the returns. It's a little bit more about the safeguard of the capital. Just like Jeremy preaches every single day in the trading room, it's about risk management. So as long as you can find the team out there that's really prudent with the risk management and they're on the conservative side, you should have a professional or a team of professionals really that can navigate rough waters regardless of what's thrown at them. Doesn't mean that they're going to make a horrible deal, a great deal, but oftentimes, and I've heard this many times from people that have been around for way longer than me in investing in syndications, is that a good sponsor, a great sponsor, can turn a very mediocre, a bad deal into a very acceptable return. But a bad sponsor can turn a great deal into just a horrible loss. So oftentimes it's not what's thrown and what the market does. It's mostly about how you maneuver it, you know. The other risk with syndications is it's liquidity. Just like Lewis said about residential real estate, it's not any different. This is also real estate. Real estate in itself is super illiquid by nature because it takes time to get rid of. Syndications and real estate funds even more, because you're buying into a private company, into a private, it's private equity essentially. And so this isn't something that you can go on your broker and hit sell and you get out of your BlackRock shares. These are a lot harder to exit. So you're going to want to make sure that you put in capital that you don't necessarily need back. And these syndications and these funds have typically anywhere between a 5 to 10 year lifespan. So you want to invest in some that meet your investment criteria and your investment outlook. Obviously,
yeah, I love that you're mentioning that as a risk. It's a very, very valid risk. So if something crazy happens in your life, team, whatever it is, right? wild things happen. That money can be locked up and there's nothing you can do about it. Now, I view that as both a risk and a positive for me personally. Right? This is all my opinion, of course. But the reason I say it's a positive is because sometimes, in fact, type a 1 to the chat pane if you've stacked some cash in your bank account at one point and you're like, all right, cool, I'm gonna save this until something happens. And then sure enough, 3 weeks later, something happens and you pull that money, you spend it, right? It's happened to me. I mean, all kinds of stuff. But what if I take that money and I throw it into a really good deal and now that money is locked up? Then I can't access it. So then my brain has to figure out other routes. Does that make sense? My brain has to sit down and go, all right, how can I do this without that money? Because that money is gone. That money is out of my life for 3 to 5 years. There's nothing I can do with it. And so now I have to get more creative. And this is just my opinion. This is all me personally. I like battling back from that standpoint sometimes, where now all my money is gone and I have to figure out something else, some other way to create that income or that cash flow or that savings or that monetary boost, whatever it might be.
Well, I definitely agree with that. That's a good way of looking at it, Jeremy, because like you said, it's still an asset, right? It's still cash flowing. And so if you're having issues and you feel like, man, I really need this money back, well, that cash flow is kind of alleviating that situation to begin with. And you have an asset sitting there that when this time, 3, 5, 4, 8 years later, whenever it is, boom, you get this nice chunk of cash back plus your profit. Then now all of a sudden you're very excited because your brain, like Jeremy said, you found the way of getting out of that situation. Us humans, we're just phenomenal at finding a way out of bad situations. We figure it out all the time. Obviously, another risk here is the economy, right? It's just like we said with residential real estate is affected by the economy. Again, syndications and funds tend to sometimes invest in slightly different ways than you would. So again, the cash flow stays alive. And so there is a really cool saying out there that I've heard. I'm not sure where I've heard it, but it basically goes like this. Cash, equity comes and goes, but the cash flow will continue to flow, right? So if the economy goes down and you're in the middle of a syndication, the real estate inside that syndication might devalue a little bit, but you're still cash flowing. And then we go through the cycle. That's why these things are done in slightly longer time frames in order to be able to, most of the time, weather a storm and a downturn in the economy. The other risk with syndications is over leverage. And I think that's something that happened with a lot of syndications over the last 12 months. There's a lot of syndicators that because actually not 12 months, like 24 months before the rate started to increase this year, there was a lot of syndicators taking very outsized risks, taking massive amounts of leverage, of debt, right? And real estate is amazing because you could leverage, but there is a certain point that leverage becomes unfavorable. And so one of the things that you want to do whenever you're checking out a syndication is just breeze over that leverage side of it and see what it is that syndicator plans to lever at, whether they're going to lever at, 85%, which I've seen some syndicators do, or they're going to be at 65%, which is a more prudent, more conservative, or somewhere in the middle where you feel comfortable with the risk, because that's absolutely come into play right now within the industry. Everybody who had a great short-term rent because they were turning a property over and now they were looking to refi right around this time, and rates are, way higher than they were, not double, but almost double what they were when they initiated their deal 24 months ago. So I think that leverage could really be a risk inside of syndications. Does anybody have any questions so far there? If not, let's get some threes going so we could get to the third way. All right. I saw a little question there pop up. Luis, what was Francisco's question?
Yeah,
I left my screen. Can you
Francisco's
help me out?
asking, do passive investors get a tax bill when you sell the property after a few years? Are they also able to participate in a 1031 exchange and move on to the next deal?
Ooh, that is beautiful. Francisco asking some deep questions. So, Francisco, absolutely. Yes to both. If a syndication exits and they sell their properties, you are going to hopefully get a nice check for profits on that equity that you submitted and that they sold. So there will absolutely be tax liabilities there unless the syndicator exits as a 1031. Now, there's many instances where syndications or syndicators exit as a 1031. There's many instances where it's better to just sell the property outright and then put that same investment with that same syndicator or with a different syndicator into their next investment. And a lot of these guys are doing various tax strategies so that they'll alleviate that tax gain that you got mostly or almost all completely. Again, not a CPA here, but I've seen it done many times where you just roll your investment into the next multifamily acquisition, let's say, and they do some cost segregation, which is a really cool tax strategy that allows you to depreciate the property year one. And then all of a sudden that $50,000 or $100,000 profit check that you got turns into a $20,000 profit. So you don't really mind writing a very small check to the IRS because you were able to participate in those tax deductions. Does that make sense, Francisco? And does that help? And now as a 1031, you are also able to come in to the syndication as a 1031. That's a little bit depends on the syndicator itself, but you absolutely are able to come in using a tick from exiting one of your properties, doing a 1031 and jumping into a syndication.
Yep. And Francisco, you're 100% ready for that, by the way, brother. Me knowing you and knowing you well, you can absolutely do that so that we're clear. And also to answer Marta's question about Fundrise. So Real Life Trading does have a video on Fundrise that Thomas did, but they're more, I don't know the exact language they're using, but they are what's called a crowdsourcing. So they're not a syndication because you can invest in these deals. But really what you do is behind the scenes is you're investing into a group investment that you give to someone that they end up buying into the investment. So this all happens behind the scenes for Fundrise and companies like that. But long story short, and this is just my opinion, of course, I don't think it's worth it. I don't think it's worth putting in $400 into a group crowdfunding type of real estate investment like that. I would rather take $400, buy a plane ticket and a hotel room to a seminar, go meet somebody and find out what they need from me. And then I go fulfill the thing that they need from me and make money from it that way. Because the scale of how much I will make from that $400 investment into myself and into that network will far outweigh the 10% return year over year that I'm gonna make from that $400 invested into a crowdsourcing thing like Fundrise.
Yes, sir. You pour that $400 into yourself, make 400 grand, and then get that 400 grand and put it into some syndications, into some rental real estate, or into our next and third way to stop trading your time for money.
Type in a 4 if you want it. Type in a 4. Let's see the 4s.
4.
Let's go. All right, Lou, let's flip that screen,
This-
please.
There you go.
This one, I wanted to bring kind of like a little bit of a hybrid, right? So this is a mixture between a residential real estate investment, which is going to require a little bit more time, obviously with a property manager, but you still, it's going to take a little bit more to manage that property manager. A syndication, which is totally passive. You meet the sponsor, you check out the deal, you send your money, you're good to go. You review your financials every quarter, every month, or yearly. With triple net properties, you're kind of in the middle. What is a triple net property? Essentially, triple net properties are commercial real estate investments for the most part, and they are also called net or net lease properties. And the reason is because the tenant is responsible for paying all the expenses. So the triple net is because the net payment that you get is free and clear of all expenses. The tenant pays the insurance, they pay the taxes, they pay the maintenance. There's some other two ends, double modified net leases, sorry. And those are a little bit differently. I'm strictly talking about triple net leases here, where the tenant is responsible from A through Z, everything. And the landlord basically has little to no involvement in the day-to-day responsibilities. And if they do have some involvement, they then get reimbursed by the tenant. So sometimes some of these triple net leases, they'll have the landlord paying for the taxes or paying for the insurance, and then the tenant go ahead and reimburses you. So you still have net income. And these, I'm still going to recommend the property manager. The property management fee on this is going to be way, way less than with residential properties, but it's still very, very important. And I'll share why with you a little bit later when we get to the benefits and the risk here. And not only for the peace of mind, but also for the education and the experience that these property managers bring to the table. That's very important with these deals. There's some sample properties right here on the screen, right? That Publix that you guys might go to, or that Kroger's, 9 times out of 10, that's a triple net lease. Those Dollar Generals, pretty much all of them are triple net leases. Same thing with banks and a lot of medical offices. They could
Walgreens,
all the Walgreens. Exactly. So I'm sure that's kind of ringing the bell as to what kind of spaces these are.
Let me say in a comment. So
Okay,
to simplify, the tenant pays the rent plus pays all the costs associated to occupying the space. That is correct.
Bingo. Exactly. All the costs associated with that real estate. And let's go ahead and flip over to the benefits, Luis. So there is, as I mentioned, this could be a small tenant as well. It doesn't always have to be something so big. I don't want to give the impression that it's only like Chase Bank that's going to be your tenant, or somebody like Dollar General. It could be a lot of mom and pop businesses, a lot of small retails. They fully agree, or even offices. They make you do triple net leases, and the tenants are responsible for all of it. But there's a major difference between having Joe the realtor as your tenant versus Chase Bank or Joe the plumber, whatever you want to call it. Huge difference in their balance sheet. Huge difference in the type of tenant and the tenant quality that you're getting. And that's very important with these triple net properties, because it could be a great benefit and it could also be a great risk for you, depending on what kind of tenant you have. The best part about these things is the cash flow. The cash flow is relatively predictable because, as we said, the tenant covers all the expenses. Even if you pay for it up front, you get reimbursed, so that your cash flow on an annual basis is very predictable. These leases have escalation clauses for rent already built into them, so you know what your cash flow is going to increase to every year, which is amazingly beautiful. And leverage, right? Just like with all types of real estate, you can get loans, you could get debt, and the leverage with these properties is amazing. It goes above and beyond most of the leverage programs that are out there for other types of properties. There's very specialized loans that I'm not going to get into today, but if you really like this asset class, you can talk to a lender that specializes in triple net properties, and there is a bunch of cool loan programs out there for these. These are fantastic wealth creation machines because they're long-term tenants. Typically, for the most part, you could have some shorter, but the ones that I'm talking about, the good ones, are 10, 15, 20-year leases. And those are where you want to be at when you're dealing with these types of properties. They have, picture a 10-year lease with 3 5-year extensions. You essentially have a 25-year tenant on your hands, so long as the business does well and you have a quality tenant on your hands. How amazing is that? That tenant will essentially pay off that debt for you if you don't refinance before the lease is completely up. Diversification comes into play here again. And the cool thing about these triple net properties is that they don't track the rest of the economy that closely. So while residential properties might not be doing well, triple net properties might still be doing okay. And while the stock market might not be doing well, triple net properties might still be doing okay. They're not necessarily super correlated with one another. And once again, your tax benefits. As with most real estate, you get that depreciation and all of these other tax benefits from the debt interest payments that you can deduct, as well as the depreciation on the building, cost segregation, and a bunch of other cool stuff that we're not going to get into today here. Luke, what are my risks?
Boom.
Liquidity, once again. Have we noticed a trend, team? Real estate is not the most liquid investment vehicle. It takes a little bit to exit. You have to sell these things. The economy always affects real estate in one way or another. Like I said, triple net properties perform slightly different than other assets, but there's still always a risk of a bad economic situation, hindering your tenant's ability to pay rent or to grow their business. Lease expiration, as I mentioned before, is a major risk here. Typically, these properties are hard to fill. They're not the easiest tenant pool to come around. So you want to make sure you have those long-term leases and that you continue to nurture that relationship and know ahead of time when your tenant is going to vacate so you can mitigate that risk. And again, like I mentioned before, Chase versus Joe the Realtor, big difference and the tenant risk profile. That is essentially what I have for you guys on Triple Net Properties. Any feedback from the team? Any questions? Gina's got a question there. Lou, if you want to fire that off.
Yes. All right, Gina, I love this. I'm very curious to learn more about the details about it. I'm also a small business owner having to lease a space from a practice, pharmacy, and other practitioners. I've been wanting to be the one leasing the space rather than renting it. It's been such a leak in generating wealth and having the capacity to invest in more than the business itself. That's totally correct. You can do it. You can buy the commercial real estate and release it. One of the things that was just came into my mind, one of my good friends, pretty much my brother, he does executive suites. So he leases basically the whole floor of a big building and separate through little offices. So he always has, major little realtors, accountants, all kinds of people renting a space over there. And his network, it's huge because he has a huge portfolio of people that have been for years coming in and out, and every time he has some kind of issue, question, whatever, just pick up the phone and he knows somebody. So that's a great way of doing it.
I love that you said that, Lou, right? Because not only is he making money with that, he leased a floor and then subleases that floor to other tenants. He makes cash flow, and he's building an amazing network of business owners. And Gina, to your point, I am a huge advocate for business owners owning the space that they operate out of. If you've been in business for more than 5 years and you're going to stay in business and you're paying rent and your rent is anywhere comparable to your mortgage, you should absolutely be looking at buying, even if it's a little bit more. And now the better part is, like Gina said, you buy a space slightly bigger than you need and you lease part of it out. And guess what? That tenant's paying the mortgage and you're owning the property. And here's a really cool one, team, before we close out. If you are a business owner, Gina, and you want to buy a space for yourself, the SBA will give you a low interest loan with only 10% down payment, typically, not all the time, but for the most part, as long as you are going to occupy 51% of the space that you're buying. So if you're buying a 10,000 square foot building, you're going to occupy 51% of it, the SBA will lend you at a 10% down payment. So you get to leverage 90% of their money. How amazing is that? Then you lease out the remaining 45, 40%, whatever you don't need, and that tenant pays the mortgage for you. How do you love that?
Yep. There's always ways. There's always ways to
that
do
just
it.
fires me up, man. That gets me so excited, when I think about these things, how cool real estate is. So team, thank you so much for sharing your time and your morning with us. I know Saturday mornings are precious to everybody. I'm so glad. I hope that we added some value. If you have any further questions, keep throwing them in the chat. If not, please, on your screen, you have our contact information anytime you want to reach out.
I'm sharing that information on the chat panel so they can copy and paste it or link from there.
My pleasure, Leslie. Blake, thank you for being here. We appreciate it.
Martha,
any questions?
Jay,
If you
thank you
guys
for being here.
Yep.
We love questions. Please shoot before we go.
If you want to get into this active and you need some help, please reach out. We are starting a new mentorship group next week. If you want to get into this passively and you want to chat, please reach out as well. Our contact is on the screen. Thank you so much, guys. Happy weekend.